What's up, guys? It's Cash Flow Card. Today we are doing my watch list for 2024. By no means am I recommending you buy these stocks. I'm just making this video so you guys can kind of have a sense where my head is at going into the new year. Obviously, new year, that's very exciting. We're all probably setting a lot of goals, kind of reevaluating a lot of things, and with that comes, okay, what stocks am I going to watch this year? Where's my head at? Where do I see the portfolio going this time next year? Let's get into it. I'm going to share, I guess, 4 picks today. One, I'm interested in adding. I'm interested in building out the position a little more. I've already started a position. Another one, I've got a pretty big position already built into it, but I just can't wrap my head around not adding more. So I'm probably going to nibble at this one. And then I'm going to do 2 stocks that are in the consumer staples sector. And I have started buying one of them as it's kind of dipped. But these other 2 stocks, I'm really looking forward to, if we get like a bear market in this next year, a real bear market. Not the indecision we've seen, but a real bear market. I'm going to add more aggressively these 2 consumer staples stocks. So let's get into it. First one up, you can probably see on the screen. It's TROW price. Ticker is TROW. You can see, let's see. I've added already this year 6 shares at an average price of 99. So, I've been trying to pick up shares under 100 anytime I can, but, I'd be willing to add aggressively in this one as long as it stays in this consolidation or even lower between 80 and 120 TROW price. I'm going to be adding. So I guess on my chart, I'll put in like all the way through 2024. I would not mind adding shares of this in kind of the shaded area here. And, we'll look at kind of the why for this too. So with TROW, it's got a wide economic moat. Being in the asset management, I guess, sector, it's a very sticky sector. Okay. So what I mean by that is people have their retirement dollars with TROW. And they have their 401ks with TROW. They're in TROW funds, whether it's some sort of target year for retirement, whatever it is. And it's sticky in the sense that a lot of consumers are unlikely to kind of move their money, make some sort of, big financial move with their retirement money. They kind of just want to set it and forget it with a lot of their dollars. And that's where the moat comes from. We'll look at some of the free cash flow growth. Let's see. Scroll down here to free cash flow per share. We can see December 2018, $5.99. And, it hasn't been some perfect uptrend like we usually like to see. But, at least in the past 5 years, we can kind of get a sense of, okay, this thing's moving in the right direction. I will mention on this one specifically, with TROW price, sometimes it's hard to get some perfect trend because so much of their free cash flow is determined by, when people are retiring, when people are taking RMDs out of their accounts. But, as long as they have the free cash flow to sustain their dividend, which they have historically, I'm really excited about this one. We'll look at their... And I've talked about it on this channel. Cash flow payout ratio. It's a metric I like to use to kind of get a sense of, okay, of their free cash flow, what percentage is actually going towards funding their dividend payouts? They're at 50%. So again, if they're only using half of their free cash flow to pay out dividends to shareholders, they've definitely got room to continue to grow it. With that being said, we will look at the dividend growth rate. Their most recent dividend increase was 3.85%, which, isn't amazing, But I do think a lot of dividend paying companies in this past year have like kind of slowed down their growth rate. We've seen a lot of like uncertainty within the markets. A lot of these starting yields have gotten obviously pushed up as stock prices have fallen, for TROW especially. So, I guess this slower dividend growth rate for a 1 year period does not really concern me too much. We look at the 3, 5, and the 10 year, they're all sitting over 10 to 11%. So, historically, this thing has aggressively grown its dividend. Let's see how many years in a row. It's got 37 years of dividend growth. Like I said, that 5-year growth rate sitting at almost 12%. The current dividend yield is 4.5%. I really like this one. And, apart from that, I think it's pretty undervalued. So we should get some nice total return there as well. I've talked about valuation metrics on this channel. What I like to use is the price to cash flow, preferably forward. If, let's say, the trailing 12-month price to cash flow and the forward price to cash flow, if they tell kind of a different story like they do in this instance, then I'm always going to opt to use that forward-looking data. And that's just kind of my own way of doing things. So we can see the forward price to free cash flow for TROW sitting at 11.29 versus this column over here is the 5-year average. Okay, so the 5-year average price to free cash flow is higher than the current at 13.57. And what I'll kind of do with these numbers, for me, it's hard to put like a fair value on a stock, but I can at least look at this and say, okay, using this metric in isolation, there could be 17% undervaluation in terms of TROW prices, price to free cash flow on a 5-year basis. I hope that makes sense. So we will move on. The next one, I already have a pretty big position built out in this one relative to my account. And before you guys go running for the hills, because I show this kind of, I guess, controversial stock, it is Altria Group, ticker MO, the leading tobacco supplier in the United States. I have 247 shares currently. My average price on this one is $44 and change, while it's currently trading at, $40 and change. Essentially, I'm down $4 a share on, almost 250 shares. That gives me a current P&L of negative 1,000. Again, I'm not really losing sleep over that number as a dividend investor. I know my total return will come, and I know it's also coming from the dividends I've collected along the way with this one. So, I'm going to continue to build out this position, but I really wanted to include this one, and we'll come back to the chart. I wanted to include this one, guys, because I think it leads us to a good point. And, okay, so we'll look at the forward yield for this. It's almost 10%. All right, so what is the market return? What is the average market return of the S&P 500, historically? It's about 10% annually, according to SoFi. You're probably going to get, a little different answers no matter where you go. But we'll say the average market return is about 10% annually. And, with Altria, what am I really betting on here? I'm betting on, okay, they can continue their impressive track record of dividend growth. It's 54 years and counting. They've been able to grow their dividend by a 5-year growth rate of 5%. And this payout ratio here is the earnings payout ratio. But, at least in that sense, it looks sustainable. So if I can get, almost this 10% return just from the dividend component, then any share price appreciation I get with this one is going to be kind of, in my opinion, the icing on the cake. Again, if you've watched my channel, you guys will know I'm not a trader, but I do like to use, my cost basis and my profit loss open. I like to use it as sort of a gauge for, okay, how much bang for my buck am I getting per se? So again, I know there's risk with this one. People talk a lot about how, smoking, we've talked about on this channel actually, smoking is becoming a thing of the past. But, if we can kind of separate away from that, and if we look at Altria's net income, they have had, one of the more solid uptrends we've seen in terms of net income from any of the companies we've analyzed or looked at. So, I know there's a lot of risk. I know there's political stuff, legislation stuff. But again, I'm really interested in, if I can make my bet that Altria is going to be able to continue paying out this dividend and increase the dividend, then I'm essentially going to be getting that 10%, target return all from that dividend component. And that makes me obviously really excited as a dividend biased investor. Again, this is not financial advice. This is for fun and entertainment purposes. Obviously, if there wasn't any discretion in this game, then we would never have great investors. We would never have the Warren Buffetts, Ray Dalio. I don't know. Who's your guys' favorite investor? Okay, so we'll look at another one. So I mentioned I'm interested in building out TROW price because it's a small position for me right now. And I'm very attracted to the stickiness of the industry, TROW's wide economic moat, their dividend sustainability, and historically they've been able to aggressively grow their dividend. Bottom line is I'm building out the TROW position. We looked at Altria. You can see I've got a position pretty built out in it. These 247 shares are yielding, nearly $1,000 in passive income every year. Okay, so Altria is one I've already built the position out in. I want to keep adding. It's super attractive to me. I understand the risk, but I think the risk reward with this one is, I think that in the long term, it could pay off really well. Also, one other thing I want to mention with one like Altria, where you're getting, such a high dividend from, the power that you have if you're reinvesting your dividends in terms of compounding in your portfolio, is very notable. So I don't necessarily use a drip where I'm reinvesting dividends back into, the stock that paid them, but having that, income come into my portfolio quarter after quarter, month after month, that can really speed up the compounding of your portfolio. And as you get further into this game, you'll really see that. Okay, so without going on too much of a tangent, let's move on. Okay, the next two, like I said, they're going to be consumer staples type stocks. I've started adding one of them. It is Coke. Let's see. I have 7 shares. So for me, it's a very small position right now. I don't think I got in, perfectly on this dip. I was a little late on the trigger, I guess, but, that's just a matter of when I have the capital to invest. Coke, I want to build out as kind of a cornerstone position. I think it's like a stock with the widest moat you could find. I guess we can look at some of their metrics too. But, for me to really build this into a bigger, sizable position, I do think that I would want to see some sort of bigger discount. So, if we do see a recession or bear market in 2024 and that sentiment kind of hits Coke, then I will build this one, I guess, a little more aggressively. I think it'll be a great one if you can get at the right price, for upside capture after a recession, lock in a great dividend yield. See what it's at right now. Okay, right now the dividend yield is 3.16. They're a slower growing one in terms of the dividend growth rate, but they have that track record. This is obviously a very mature company, globally diversified. I really like it. I think it's the best sleep well at night stock. I don't see Coke going anywhere in any of our lifetime, but again, with that being said, I don't want to overpay just because it's value. You know what I mean? Valuation is everything. I mentioned I've started adding this one. We'll peek at the valuation. Price to free cash flow in terms of a forward basis, its current is 21.14. That 5-year average we've been mentioning is almost 24. So, that gives it a relative, I guess, undervaluation of almost 12%. I would like to see this one fall into a little deeper discount, but I'll definitely nibble at it, in the year that to come, as I have been this year recently. And then lastly, this is one I don't have in my portfolio yet, but I'm kind of in the same boat where it's, it's high on my watch list. I will be really excited if the market has a bad year next year, I guess, because if it hits some of these names, we're going to see I think once in a lifetime opportunities for some of these stocks. And that is Hershey. So I've actually looked at this one before, and I've made note on my chart here of the 170 level. I think that'll be when it becomes very attractive to me. Not to say that I'm not going to start, averaging into this one pretty soon. Even within the coming weeks, I might start this position. But okay, so yeah, Hershey's one I'm building out. Similar boat as Coke in the sense that it's a consumer staples giant with, a wide economic moat that comes just from, I guess, consumer preferences, experience, volume, and global diversification. We'll look at Hershey. It's hard doing this watch list. There's so many things to look at, guys. So I'm just trying to go over a few of the things I see without making this video too lengthy. And okay, so this one has grown the dividend a little more aggressively than Coke. However, it does only have the 14-year, track record of dividend growth. And I think one of the reasons I haven't added it yet is because this starting yield of 2.61% is, it's not, it's not the most exciting thing in the world to me. I would like to see if I could get Hershey at 3.5%. Hold on, we'll do some math here. So the annual payout on a forward basis is $4.77, as you can see right here. So, I mentioned 170. I'd be interested in it. That would put us at a dividend yield of 2.8%. If it falls even lower to 160, that would get us to almost a 3% starting yield. I mean, if it can go to 150, that'd be 3.2% on the starting yield. Guys, this is what you got to do. If you love a company, it doesn't mean, you rush to throw capital at it. That is not the name of this game. But more so, it's being patient. It's kind of making a watch list of stocks that you want in your portfolio, whether that's in a month, 2 months, in the next year. And it's building conviction in these companies that aren't yet in your portfolio. And then when they do get attractive, you're ready. You've got those dividends coming in. You can reinvest. Hopefully you can invest new capital. Depending on your situation, everyone's going to be able to invest a different amount of new capital every month. But, I think the important thing is out of every paycheck you get, whether you can just set aside, $20 from that paycheck, okay? $20 for the month or $100 for the month. You know, maybe you're doing well, you can put $1,000 a month in, whatever it is, guys. That consistency, building those habits and having these watch lists where you know where your money's going to go, you know what stocks you want to add, you know which positions you have that you want to continue to build out. You know, that's what's going to separate, I guess, the average dividend investors who, you know, are going to get shaken out of this game. They're not going to be able to take advantage of opportunities, and the great dividend investors, guys. And on this channel, obviously, I want to build a community of like-minded, great dividend investors. I understand we've all got different risk tolerances. Some of you guys might not want to buy Altria. Some of you, you know, might be more into ETF investing. Whatever it is, guys, we are a community of like-minded dividend investors. We're building passive income. And if you want to join this journey, feel free to subscribe. I've got a lot of exciting stuff coming out for the new year. I think I mentioned that, but you know, as I've been new here on YouTube, I feel like each video's kind of been not experimental, but it almost feels experimental when they're like my first videos coming out. Like, so in the new year, I'm really hoping to get, you know, kind of a monthly schedule. I'm trying to take the content up a level. And if you've been with me and you're sticking with me for this journey, thank you so much. Everyone have a great rest of your day. And I guess Happy New Year.